Right now, as you're watching this, one of the most powerful financial institutions on the planet just told you to walk away from silver. They said it plainly, almost casually, the way someone does when they really don't want you to think too hard about what they're saying. And the timing of that message, the specific moment they chose to deliver it, says more than the message itself ever could. Stay with me here, because what I'm about to walk you through isn't just about silver. It's about how financial narratives get manufactured, who manufactures them, and what you need to understand to protect yourself from being on the wrong side of a trade that could matter enormously for your financial future. Before we get into all of that, if you're new here at Element Axis, we do this kind of work all the time. We take the institutional messaging that gets handed to retail investors, and we break it apart piece by piece to figure out what it's really saying underneath the surface. If that's the kind of analysis you want showing up in your feed, hit that subscribe button right now. It takes 2 seconds, and it keeps you connected to this conversation. We have a community of people who think critically about their money, and you belong in that group. So let's start with what actually happened. A major global investment bank, one that manages more money than most governments will ever see, published an analyst note targeted directly at silver investors. The message was straightforward on the surface. Over the next 12 months, they said, you should not expect much from this metal. Their words essentially amounted to this: silver is too volatile, positioning is declining, and the recent retreat from a key price level proves that there's limited value here as a long-term hedge. That was the message. That was what they wanted you to read, absorb, and then act on. Now I want you to think about something before we go any further. Think about who reads those analyst notes and how they flow through the system. They go to wealth managers, to financial advisors, to the people who manage your retirement accounts, and yes, they filter down into financial media, and eventually to you, the individual investor sitting at home trying to make smart decisions. And when you read a headline saying a major bank sees limited upside for silver, most people nod and move on. They assume that because the institution is large and the names attached to the report have impressive titles, the analysis must be objective and accurate. That assumption is one of the most expensive habits a retail investor can carry. Let me be precise about something. I'm not saying these analysts are inventing data. The numbers in this report are not fabricated. What I'm saying is something more subtle and frankly more important. The way you frame real data can lead someone to a completely false conclusion. You can take true facts and arrange them in a way that creates a deeply misleading picture. And that is exactly what happens in this particular note when you sit down and actually examine the claims being made. So let's do that together. Let's go through the specific arguments one by one and ask whether the conclusions they point toward are the only logical conclusions, or whether there is another way to read the same exact information. The first major claim in this note is that silver prices have been extremely volatile over recent months, spiking dramatically during geopolitical tension before pulling back hard. They specifically highlight that the metal approached a major psychological price level, a round number that has been watched by precious metals investors for years, and then retreated. And they use that retreat as evidence that silver lacks staying power. Every single word of that is accurate. Silver did spike. Silver did retreat. The metal absolutely did approach a historic level and get pushed back. But the conclusion drawn from those facts is where the analysis falls apart completely. When a market approaches a major resistance level and gets pushed back, that is not evidence that the market is weak. It is evidence that the level is being defended. There is a massive difference between those two things. If you've been investing for any length of time, you know that every significant breakout in market history was preceded by multiple failed attempts at the same level. You don't sail through major resistance on the first try. What happens instead is that there is a fight. The bulls probe the level, the bears defend it, and price goes back and forth until enough buying pressure accumulates to overwhelm whoever is defending that ceiling. The retreat from a major number is not a rejection of the trend. It is the early stages of a siege, and right now that siege is very much ongoing. Think about what it actually means that silver made the kind of dramatic move it made in such a short period. Prices don't move like that because of a whim. They don't move like that because of a passing trend. They move like that because something structural is happening in the supply and demand equation that the market is slowly waking up to. And when you see a metal sitting right below a level that would represent a truly historic psychological breakout, the narrative that says, walk away, there's nothing to see here, should immediately raise a flag in your thinking. The second claim in this analyst note is that volatility in silver has been extraordinarily high, at levels comparable to or even exceeding some of the most volatile assets in the market right now. The framing is clearly designed to create fear. The subtext is, look how dangerous this thing is, look how wild the price swings are. You don't want to be holding something this unpredictable. But I want to flip that framing on its head entirely. Because the way institutional analysts describe volatility versus the way it actually functions in a real portfolio are two very different things. Volatility is not inherently bad. Volatility means the asset is moving. Volatility means there is real price discovery happening. Volatility means that buyers and sellers are actively fighting over where the correct price should be. And for long-term holders, volatility is not a threat. It's the mechanism that creates opportunity. The people who built genuine wealth through markets did not do it by avoiding volatile assets. They did it by having the conviction to hold through volatility when the underlying fundamentals of the asset remained intact. If the reason you hold silver is because you believe the supply is constrained, because you believe industrial demand is growing faster than new supply can meet it, because you believe the monetary system has real structural vulnerabilities, none of those reasons disappear because the price swings aggressively in the short term. The weekly price chart is not the same thing as the fundamental thesis. Drop a comment right now and tell me, honestly, when you see a sharp price drop in an asset you believe in, what's your first instinct? Do you question your thesis, or do you start looking for where to add? I read every single comment on this channel, and I want to know where your head actually goes in those moments. The third claim in this note is the one I find most interesting and most revealing. The analysts point to declining positioning data as evidence that silver is falling out of favor. They cite lower positions in exchange-traded funds. They cite reduced activity in the futures markets. And they use this to argue that the market is voting against silver with real money. On the surface, that sounds compelling. When fewer participants are buying paper positions, that's bearish, right? Well, maybe, but only if the paper market and the physical market are telling the same story. And right now, they are not. Here is something that does not get discussed enough in mainstream financial coverage. The paper market for silver and the physical market for silver are two fundamentally different things. The paper market is where futures contracts and fund shares change hands. It's fast, it's liquid, and it responds heavily to institutional flows and computer-driven trading. The physical market is where actual metal changes hands. It responds to real-world demand from manufacturers, from governments, from investors who want something tangible. When the paper market shows declining positioning while the physical market continues to show tightness, elevated premiums, and strong delivery demand, the two markets are diverging. And when they diverge, history is very consistent on what happens next. The physical market eventually wins. Because you cannot manufacture physical silver out of thin air, you can create as many futures contracts as you want. But you cannot do that with real metal. Real metal has to be mined, refined, transported, stored, and delivered. And when the supply of real metal is structurally constrained, the paper price eventually has to come up to meet physical reality. That is not a theory. That is basic economics. And if you know someone who's been wondering about precious metals lately, share this video with them. This is exactly the kind of framework they need before they make a decision based on a bank headline. Now, the fourth claim is honestly the most jaw-dropping thing in this entire note when you actually stop and think through its logic. Even while telling you that silver has limited upside, these analysts openly acknowledge that the silver market is expected to remain in a supply deficit of roughly 300 million ounces. 300 million ounces. Let that sit with you for a moment. The world consumes 300 million more ounces than it produces every year. And yet the conclusion is that price has limited upside. Apply that logic to anything else in your daily life. If the housing market in your area is undersupplied, what happens to prices? If a product everyone needs becomes scarce, what happens at the checkout counter? Scarcity has a price. Deficits have a price. The only way a deficit of this magnitude does not result in higher prices is if supply expands dramatically or demand collapses. Neither of those things is happening in silver right now. The demand side for this metal is being driven by forces that are not going away anytime soon. Solar panel manufacturing requires silver. Every panel that goes on a rooftop, every utility-scale solar installation, every government pushing toward renewable energy targets is consuming silver in quantities that the market is struggling to keep pace with. Electronics require silver, medical devices require silver, defense technologies require silver. This is not a collectible or a nostalgic relic. This is an industrial metal with deep ties to the fastest growing industries in the modern economy. And when you layer that industrial demand on top of the monetary and store of value demand that precious metals have always carried, you end up with a supply-demand picture that is, to put it plainly, structurally bullish. Not cautiously bullish, structurally and fundamentally bullish over any honest long-term analysis. So why would a major institution put out a note that acknowledges the deficit while simultaneously dismissing its implications? This is where it gets genuinely interesting, and where I'd encourage you to think like a market participant rather than a passive consumer of financial content. Large financial institutions are not just research organizations. They are active market players. They have positions. They have clients with positions. They have counterparties sitting on the opposite side of trades. When a bank publishes a bearish research note on an asset, the publication of that note is itself a market event. It shapes sentiment. It influences retail behavior. and retail behavior moves prices. If you have meaningful exposure on the short side of silver and silver is approaching a level at which your position becomes extremely uncomfortable, what do you want retail investors to do? You want them to sell. You want them to stop buying. You want them to read a headline about limited upside and decide this is not the moment to be adding to their position. Every retail seller is a buyer for someone on the other side. Every retail hesitation is one less person pushing price through a level that's being defended with everything available. This is not a shadowy conspiracy. This is just how market structure works at the institutional level. Once you see that dynamic clearly, it changes how you read these notes entirely. Now let's look at the technical picture, because the charts add important context to this conversation. Silver broke out from a meaningful level earlier, and that breakout was real, but it reversed. The bulls found a floor at lower levels, and since then the metal has been in a contested range. The resistance overhead is acting like a heavy ceiling, and it is going to take real sustained buying pressure to crack it in a durable way. What that means for investors is that the market is in a phase that tests patience. It tests conviction. It tests your ability to sit with an uncomfortable position and not let short-term price action rewrite your long-term thesis. This is historically where weak hands get separated from strong hands. The mechanism that does the separating is exactly what you're seeing right now. Scary headlines, declining sentiment data, analyst notes saying, walk away. That is the shakeout. That is how the transfer happens, from people who can be frightened out of their position to people who cannot. Meanwhile, gold has been holding its key levels with considerably more stability. It found major support, and that level is now acting as a floor. And when you look at the relationship between gold and silver, something important is happening. Gold is being preferred right now by large institutional players. It is the cleaner flight to safety trade. Silver is more volatile, more contested, more tied to industrial demand. So when risk appetite is uncertain, institutions lean into gold while silver drifts. But here's the pattern that shows up consistently in precious metals markets. When gold runs hard and silver lags, the ratio between the two gets stretched to an extreme. And stretched ratios in these markets have a consistent habit of snapping back. When the snapback comes, silver does not drift, it moves fast, and it moves in concentrated bursts. The people positioned ahead of that compression capture gains that a slow and steady asset simply cannot deliver. Let's also talk about what is happening in the broader stock market, because this matters directly to where precious metals go from here. Equity markets are under real pressure. There is a meaningful gap between where prices are and where the underlying technical support sits. Whether that resolves through a slow sideways grind or something sharper is still an open question. But the direction of pressure is not ambiguous. And here is why this matters. When stocks correct meaningfully, capital looks for somewhere to go. Some goes to cash, some goes to bonds, and historically a meaningful portion finds its way into hard assets. Gold and silver have benefited from equity market stress consistently over decades. Not immediately in every single case, but over the medium term, the pattern is well established. Hard assets attract capital when confidence in financial assets begins to crack. The conditions that have historically driven that rotation, elevated geopolitical tensions, historic debt levels, currency pressure globally, those conditions are not just present right now, they are intensifying. Here's a framework I use when things get noisy and every headline seems designed to make you doubt yourself. When I'm trying to figure out whether a price move or a negative narrative represents a real change in the fundamentals or just a manufactured distraction, I ask 3 questions. First, has the supply-demand picture actually changed? Has new supply come online in a way that closes the deficit? Has major industrial demand dropped off? If the answers are no, nothing fundamental has changed. Second, are the physical indicators diverging from the paper price? If premiums in the physical market stay elevated while paper price drops, the physical market is telling a different story. Real buyers at real prices are still there. Third, who benefits from the narrative? If the message being pushed at this specific moment primarily benefits parties who are short the metal, that is worth noting, not as proof of anything, but as a signal worth weighing against everything else you're seeing. When those 3 questions point consistently in the same direction, I don't panic. I pay attention, I take notes, and I wait. There's also something that does not get nearly enough coverage in Western financial media, and that is the physical transfer happening across global markets right now. While paper markets and major financial centers get hit with large sell orders, physical metal continues to be absorbed by buyers in Asian markets who have a very different long-term perspective. Physical premiums in those markets have remained elevated even when paper prices drop. And this creates a mechanism that is worth understanding clearly. Every time paper selling drives the price down, patient physical buyers step in and absorb metal at a discount. And once that metal moves into those hands, it does not easily come back. Over time, this represents a structural tightening of available above-ground inventory. It is happening quietly, without fanfare, and without showing up in the headlines you scroll past every morning. But it is real, and it matters for where this story ends up. Now let me address those of you who have been in this trade for a while, the people who started paying attention to silver when almost nobody in mainstream finance cared about it. The people who bought at levels that now look like obvious gifts, but who went through years of sideways action, negative sentiment, and skeptical friends who called you crazy for holding a metal when everything else was going up. If that is you, the move silver has made is not an accident. It is not a fluke. It is the market starting to catch up to what you already saw in the underlying data. But here is the hard truth. The recognition phase is never clean or smooth. It is never a straight line up. The validation of a long-held thesis almost always comes with enough volatility and doubt and negative narrative that plenty of people who were correct about the big picture end up selling too early because the short-term noise becomes too much to bear. The analyst note saying limited upside is part of that noise. The technical resistance is part of that noise. The sharp price declines are part of that noise. None of it changes the supply deficit. None of it changes the industrial demand. None of it changes the monetary backdrop we are operating in. What it does is test your patience and your conviction. And that test is the price of admission for capturing what happens when a major asset finally makes a structural breakout. Like this video right now, if you're finding this useful, it genuinely helps more people find this kind of content, and every person in this community who is thinking clearly is one more person who cannot be shaken out by manufactured sentiment. I want you to also consider the psychological level that everyone in this market has been watching. Round numbers in markets are not just emotionally meaningful. They are structural features of how markets actually function. Large positions get established with reference to round numbers, stop orders get clustered around them, options get written around them. When an asset approaches a major round number from below, there is real, deliberate effort from parties who have significant exposure on the wrong side of that breakout to stop it from happening. That is not conspiracy. That is rational self-interest. And when you understand that, aggressive selling near a critical level combined with bearish research notes appearing at exactly that moment starts to look like what it probably is. Defense, not analysis. For those newer to all of this, I want to be honest about what you're stepping into. This is not a neat trade with a clear timeline and a guaranteed outcome. It is a market that is genuinely complex, subject to paper-level pressure, and involving competing institutional interests that do not always align with what retail investors are being told. It will test your nerves. There will be moments between now and wherever the destination turns out to be where you will question everything, but you are also stepping into a market with a fundamentally compelling story. A story of constrained supply meeting growing industrial demand against a backdrop of extraordinary monetary and geopolitical uncertainty. That is not something I am making up. That is the story the data tells, when you read it honestly and without an agenda. Understand the fundamentals for yourself. Follow the physical indicators, the premiums, the lease rates, the delivery volumes. Watch the relationship between gold and silver and where it sits relative to historical norms. Pay attention to what equity markets are doing. And most importantly, know what game you're playing. Know your time horizon. Know your risk tolerance. Know how much volatility you can genuinely sit with before emotion starts overriding logic. Because the market will find your threshold. It always does. Being prepared for that moment before it arrives is the difference between making a great decision and making a panic decision. I will leave you with this. When a major financial institution tells retail investors to abandon a trade, right at a historically significant price level, right when the fundamental picture is arguably the most compelling it has been in years, right when physical demand is absorbing supply and the deficit continues to deepen, the smart question is not whether they might be right. Markets are unpredictable, and no one has a crystal ball. The smart question is why now? Why this specific moment? Why the urgency? Why such definitive language about limited upside when their own research simultaneously acknowledges a supply deficit that basic economics would suggest creates structural price pressure over time? When the answers to those questions point consistently in one direction, experienced investors pay attention to that direction rather than simply accepting the surface message at face value. If this kind of thinking resonates with you, please leave a comment below and let me know where you stand on silver right now. Are you holding through the volatility with conviction? Are you watching from the sidelines trying to figure out when to get involved? Are you skeptical of the bullish case and want to push back on something I've said? All of those perspectives belong in this conversation, and this community can handle honest disagreement. Drop your thoughts below, subscribe if you haven't already, and share this with someone you know who is navigating these exact decisions right now. At Element Axis, we are building a community of people who think for themselves, ask hard questions, and look at institutional messaging with clear eyes. Stay with us. We will see you in the next one.